What's up everybody? GenExDividendInvestor here. In this video I'm going to tell you the pros and cons of using Dividend Reinvestment Plans, aka DRIPs, speaking as someone who's used them for a long time. And if you're really clever and realize that me saying Dividend DRIP in my video title is redundant, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. If you don't work for the Department of Redundancy Department, then you too should hit that thumbs up button. Now, a DRIP is a toggle that most brokerages let you set, usually on a stock-by-stock basis, which, when turned on, takes the cash dividends you get from a company and uses that cash to buy fractional shares of stock in that company. So it can be an awesome way to juice up your compounding. Some brokerages like M1 have what they call auto invest, which invests your deposited cash in dividend cash based on portfolio target percentages. I'll tell you about M1's newly increased referral bonus at the end of this video because they just announced a special amount for November and December. Sometimes companies have a special DRIP program and they can actually offer you a 1% to 5% discount off market prices for their shares. Now, to make sure you understand DRIPs, let's do a quick example. Let's pretend you want to invest $1,000 into J&J. At the time I'm doing this video, J&J goes for a little over $163 a share. Let's say your brokerage doesn't let you buy fractional shares, so you buy 6 shares of J&J for $980. If we look at Seeking Alpha, we see that J&J pays out a dividend of $1.06 every quarter per share that you have. So if you bought 6 shares on Friday, October 5th, which is before the ex-dividend date of November 22nd, then on the payout date of December 7th, you would get a J&J dividend of 6 shares times $1.06 per share, which equals $6.36. If you didn't have a DRIP enabled for J&J, then that $6.36 would show up in your account as cash. You could then transfer that cash out and into your checking account and do whatever you wanted with it. Now let's assume you turned on the J&J DRIP flag in your brokerage. Then what would happen is that instead of cash showing up in your account, your J&J dividend would buy $6.36 more of J&J stock. Okay, let's say that J&J is trading at $170 on the payout date. That means your J&J DRIP would buy $6.36 divided by $170, which equals 0.0374 shares of J&J, which means you would now have 6.0374 shares of J&J, rather than just 6 shares. So that means in 3 months your next dividend payment would be 6.0374 shares times $1.06 per share, which equals $6.40, which is about 4 cents more than the last dividend payment due to that small fractional share purchase your DRIP made. And that's compounding in action, where your shares buy more shares, and then in the future you have even more buying power, and the cycle increases faster and faster. Let's look at how stock prices can impact things. We saw that if J&J was at $170, then you could buy 0.0374 more shares of J&J with your DRIP. What would happen if J&J stock price fell 50% and crashed down to $85, maybe because they lost some huge lawsuit or something? Well, in that case, your $6.36 DRIP would buy $6.36 divided by $85, which equals 0.0748 shares. What you see is that if the stock price falls 50%, then your DRIP can buy twice as much. I.e., when J&J cost $170, your DRIP bought 0.0374 shares, but when J&J was $85, it bought 0.0748 shares, i.e. it bought twice as much. And that's why dividend investors like it when stocks crash, because their DRIPs can buy more shares, which means the compounding growth can happen faster. And then when you combine your DRIP buying more shares with J&J increasing their dividend 6% a year on average, then you can really see how your dividend income can grow like magic. And that's what I like. Cash flow going up for my diversified portfolio, filled with varying types of companies which I think can maintain and grow their cash flows. Cash flow is power. Cash flow is freedom. Okay, now that you understand how DRIPs work, let's review my dividend portfolio where I can show you how my estimated dividend income grows over time if I use a DRIP as compared to if I don't, so you can really see how powerful compounding becomes with a decently sized portfolio. Okay, here we are in my portfolio spreadsheet. And my buddy Man8V has been working on an update which will allow us to update prices every 1 minute. And so you'll see as kind of doing this video, some of these prices will change more frequently than normal. Let me zoom in a bit. But I'll just quickly go over my positions and then I'll focus on the DRIP versus no DRIP. So right there you just saw an update. So Microsoft is my largest position by market value at 264 grand. Then we have Apple at 262 grand, Johnson & Johnson at 157. So I consider those 3 the crown jewels of my dividend portfolio. And feel free to watch my other videos if you want to see the details of my portfolio in my brokerage or where I go over other aspects of it. And then we kind of have Outtro, ExxonMobil, Pepsi, AT&T, Philip Morris, Procter & Gamble, Duke Energy, AbbVie, McDonald's, 3M, Coca-Cola, Realty Income, Chevron, JP Morgan Chase, Kimberly-Clark, Southern Company, Colgate-Palmolive, Caterpillar, Leggett & Platt, Home Depot, Starbucks, Travelers, and Pfizer. So the top row is my estimated dividend income with no drip on, and the bottom row is if I had a drip on. So right now my dividend portfolio makes around $87,000 a year, and you can see how that would grow just due to the estimated CAGR for the portfolio's average weighted CAGR year by year on the top line. And then if I was actually reinvesting those dividends, you can see how it grows faster. So at year 1 or 12 months from now, my estimated income would be about $93,000 a year versus $96,000 if I was reinvesting those dividends. 2 years from now, I'd get into the $100,000 mark, it'd be about $101,000 versus about $8,000 if I was reinvesting those dividends. And if you look at how long it takes the estimated income to double, it takes around, 9-ish years to double on the top line, versus about 6-ish years on the bottom line. So to double $87,000, that's about $170,000. And so you see, to get to $170,000, we get there around between year 6 and year 7-ish on the bottom line versus around year 9 at the top line. And again, if we take any of these numbers, we say how long does it take to double it? Let's say year 7 is $146,000, and we want to see how long that takes to double to get around $300,000. Then for the top line, scroll to the right. There we go, around between year 16 and year 17 to double. Or here, if we look at year 11, we're making $304,000 a year from reinvesting dividends. How long would it take to double that $300,000 to about $600,000? Well, we go from year 11 at $304,000 up to between year 16 and year 17. It's a nice visual way you can tell how your income will change based on if you have a drip or if you don't. So this is a fun chart. It shows my estimated annual income about $87,000, which is about $72.51 monthly, or $1,673 weekly, or $238 a day, which is about $55 an hour for what I call wage income, or $9.93 an hour. If looking at 24 hours a day, 365 days a year. The hourly wage income is better because it's calculating in how many hours most people work in a year and taxes and all those kind of benefits. So the point of this is to say that a dividend dollar is a lot more powerful than just a normal wage dollar. And over here you can see that the market's down about 0.5% today. And that's one of the nice things about having a low beta portfolio is that when days are down, I tend to be down less. But of course, conversely, when it goes up, you're up less on average. Okay, hopefully seeing my drip in action motivates you to invest more. Remember, don't compare your portfolio to mine, as there's no point in doing that. However, there is a point in getting motivated by what you see, so you keep investing even when the market turns south. Dividends are truly an amazing life-changing financial instrument, and they account for a material amount of the S&P 500 returns over history. From 1926 to 2008, the S&P 500 returned an average of 9.7% per year. Stock price appreciation was 56% of that, and just dividends alone, not dividend stocks, were another 44% of your overall returns. That's mind-blowing to me. And as I mentioned in previous videos, in bear markets, dividends play an even bigger role in your returns. For example, I read that if you had invested $100 into Dow stocks in 1998, then 10 years later your total share price appreciation was minus 4.5%, leaving you at $95.59 after a decade of passing time. But if you include dividends in that, then you would be at $117.95, an 18% profit on your investment and a 22% increase over stock price appreciation alone. And that doesn't even include reinvesting dividends. Thus, dividends often become the only return you receive when share prices are dropping or flatlining, unless you're doing options or something. Anyways, people like drips for a bunch of other reasons, including the fact that in the US they have been a way to avoid brokerage transaction fees for acquiring shares, which used to be a bigger deal in the past than it is today. They also like them because they're flexible in the sense that they let you effectively buy fractional shares, even though some brokers don't allow you to directly buy fractional shares. Another reason people like drips is because once that you have them turned on, the dividend reinvestment automates some of your life and saves you some time. Drips are ideal for retirement accounts because then your stocks can grow on autopilot tax-free. You would probably be blown away if you buy some great dividend stocks in a retirement account, turn the drips on, and then forget about them for a few decades. Another beneficial aspect of drips is that there's no cash drag when they're on, i.e. you have no time where cash is just sitting in your accounts doing nothing. Of course, sitting on some cash can also be a good thing, so that when things crash and go on sale, you're ready to pounce. If you're new to dividends, then you need to understand that any dividends you receive in a taxable account count as taxable income regardless if the DRIP is on. Qualified dividends have favorable tax treatment even in taxable accounts, but taxes are something you need to research because you don't want to be hit with an unexpected tax bill at year end. So I'd summarize that as saying if your dividend stocks are in retirement accounts, then there is a stronger case to have the DRIPs on, but if they're in a taxable account, then you need to think about the pros and cons more. If your dividend income in a taxable account gets significant, then you may decide to save some cash to pay for any potential taxes on your dividends. So you may turn the DRIP off on some of your stocks, or maybe some parts of the year you turn the DRIPs off, or maybe you just use your job income to pay any dividend taxation you might owe. DRIPs help you be consistent with your investing, because you're effectively buying more shares on a constant basis, i.e. each time you get a dividend. DRIPs are an awesome way to dollar cost average into your stocks, and consistency with investing is key to growing wealth. I started investing in the 90s and have had my DRIPs on for most of my investing life, in all my accounts. I turned off all my DRIPs a little over a year ago because I retired and started using my dividends to pay all my bills. A factor which let me retire early was because my DRIPs compounded my portfolio growth. So does using a DRIP always make sense? Why wouldn't you use one? Well, if you need your dividend income to pay expenses, then you probably wouldn't have your DRIPs on. Some people don't use DRIPs because they want to only invest when stocks are cheap, as opposed to automatically buy whenever dividends are paid. I think that is actually a great reason not to use DRIPs, and yet I still left my DRIPs on even when stocks were expensive. And thank God I did. Many of the stocks that I felt have been overpriced through the years, like Apple and Microsoft, ended up running way more. So while I didn't invest more myself, my smarter DRIP DCA'd in. I normally do lump sum buys when I invest, so my DRIP has always been my way to keep dollar cost averaging into all my positions, which lets them grow faster. It's hard to consistently and accurately estimate when something is cheap, so you can buy low to optimize your returns. Heck, only 10% of active professional fund managers outperform the market. So DCAing in using DRIPs is often a decent strategy to just match the market performance of your stocks. I put a lot of value in automation and simplicity, and thus I really loved my DRIPs when I was using them, but I think it's fine not to use them if you're actively and intelligently managing your portfolio. Another reason someone might prefer taking their dividends as cash instead of using a DRIP is if they want to reinvest the dividend income into other stocks, perhaps because they're at more attractive prices, or perhaps they want to invest in higher quality stocks, or maybe because they want to rebalance their portfolio sizes, like maybe one sector or stock has gotten too weighty in their portfolio. Or maybe they just want to invest the cash into higher yield stocks or whatever. Maybe you feel that the future of the company paying the dividend isn't too bright, but you still want the income it generates. So you decide not to DRIP it into it itself and instead take the cash and deposit it into some other stock you believe in more. Of course, if you don't believe in a company at all, then you probably should sell it. Another reason not to DRIP is if you have high interest debt or no emergency fund. In those cases, it's probably smarter to take the cash and pay off your debt and build your emergency fund, and then once those are covered, then go back to DRIPing. One question I've been asked is if there are certain stock sectors that are good to DRIP in or not to DRIP in. My answer is not really, as long as you understand all the trade-offs. Like, if you feel your healthcare stocks represent too much of your portfolio, then turning those DRIPs off probably aligns to your goals of decreasing their weight and adding more to other sectors. If a company has an unfortunate track record of cutting their dividend, then DRIPing it might not make as much sense as if you compared it to turning on the DRIPs for companies that had increased their dividends for decades. Those are the types of companies that I often really love to see my share count increasing in, even though I know that nothing is guaranteed. If you're someone who has a tendency to spend their cash rather than invest it, then the forced savings aspects of DRIPs will probably be good for you. Kinda like you're forced to pay your mortgage each month and doing that slowly increases your equity in it. If you have time to spend and you're good at calculating intrinsic values of stocks, then you might be suited to not always DRIP. If you do use a DRIP, then you might need to put in more time tracking all the dividends you auto-buy and the cost basis implications of your shares. Call your brokerage up if you have any questions about that. That all being said, some smart investors don't use their DRIP, including Warren Buffett. He loves cash and likes to accumulate cash before he does giant lump sum investments. While Warren Buffett doesn't DRIP, you have to realize that what makes sense for him doesn't necessarily make sense for you. He's one of the 10 wealthiest people in the world, and he said he only spends $3 a day on breakfast, has been living in the same house for over 50 years, and drives inexpensive cars. So a takeaway you should learn from Warren is to live frugally. Yes, I'm on a first name basis with him. And remember, don't waste your dividend income on material things, just keep investing. Please don't make the mistake of spending more money as you make more money. That's what most people do. They get a raise at work and then they raise their standard of living. It's an easy trap to fall into, but if you can instead invest more money and keep your standard of living the same, you'll be amazed at how that accelerates your portfolio's growth. Anyway, turning your drips on can really enable your snowball to grow, especially in retirement accounts. Drips aren't a get-rich-quick scheme, but they are a nice way for long-term, potentially lower-risk investing to steadily get more and more shares without using any additional cash out of your pocket. Of course, you could argue that using your dividend income is equivalent to cash out of your pocket, but hopefully you get the nuance. Drips can be a great way for an investor to steadily grow wealth over time, especially a young investor. If you plan to be a long-term investor in a stock, then turning on the drip makes more sense. But if you're planning to get out of a position quickly, then using a drip probably doesn't make sense. And finally, once you're retired, you can turn your drips off, get lots of bank, hit Vegas, and always bet on black. So like Shakespeare said, to drip or not to drip, that is the question. Shakespeare is the name of my Fidelity rep, by the way. And the answer to whether you should drip depends on your needs, goals, risk tolerances, etc. If you're depositing cash into your brokerage on a frequent basis, then not using a drip might make more sense since you're already actively investing. I personally would still use a drip even in that scenario. If you're an infrequent investor and like a low-maintenance lifestyle, then a drip is probably ideal for you. If you want to do tax loss harvesting, then you probably want to turn that drip off. And remember, even a small dividend portfolio becomes another income stream for you, and something is better than nothing. In retirement, it's great to have multiple income streams, and a bunch of small streams can become a river. My point is that some dividends are better than none for your life and for your portfolio. Speaking of portfolios, M1 Brokerage has a promotion running for a free $50 cash bonus for new users until 2022, and then I'm guessing they'll make it some other amount. But free is free. The way it works is you click on my M1 referral link in the description of this video and then either open a brokerage account and fund it with $100, or open a retirement account and fund it with $500. Then you need to keep your money inside the new account for 30 days from the date of deposit to get the free referral cash. There's a great story I've told before about a time when Warren Buffett was riding up an elevator filled with executives, and on the floor was a penny. When the doors of the elevator opened, Buffett leaned over and picked up the penny, to the shock of the executives. As he left, without turning around, he held up the penny over his shoulder and said, "The beginning of my next billion." I tell you that story because you're effectively leaving $50 on the ground if you don't capitalize on M1's free investing money. And I bet in 20 years that $20 would be worth $1,000. Plus, M1 has a nice user interface for investing, which I think you'll like. Make sure to check the details before you sign up to see what they're offering when you watch this video. Okay, now I'd like to do my favorite part of my videos, which are shoutouts, and I recommend you keep watching. First, I want to thank QB Leonidas, who signed up as a Patreon King, which allows us to do a 30-minute private call to talk about whatever he wants. I'm not a professional wealth advisor, but I'm happy to share my perspective on things. QB asked me if it was okay to just sign up for 1 month, and I told him of course, as I always want people to do whatever makes sense for their own finances. After our call, he said he wanted to stay a king for 1 more month because he wanted to have another call in 30 days, and I told him whatever he wants to do is fine by me. I'm about at my limit for the number of Patreon Kings that I could do monthly calls for, so if that's something you want to do, then I recommend you sign up now. Okay, now I'll shout out my new Patreon aristocrats who've signed up since my last video. So thank you Pro Tier 0, thank you Aaron K, and thank you Austin7766. Aristocrats gain access to my Dividend spreadsheet product that I use in this video, and they gain access to multiple private channels on my Dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them to the public, as well as I let them vote on which thumbnails I use for my videos, and of course they get more direct access to me. Now I'd like to do a shout out for a subscriber named Rajun, who bought this merch shirt of mine that says, "If opportunity doesn't knock, then build a dividend portfolio." If you use my Teespring merch link and order something and take a picture of it and tag me on Instagram, I might show your picture in a future video. Also, I automatically donate 10% of my merch revenue to St. Jude Children's Research Hospital. Finally, I want to do a shout out for 3 YouTube friends of mine. I'll put their channel links in the description of this video, so go subscribe. The first goes to Jerry from Retire With Less GWETF channel. He likes to focus on ETF analysis, options, as well as shares how he intends to retire using a smaller portfolio than most experts recommend you'll need. Jerry was the first person ever to sign up on my Patreon, so thank you Jerry, I really appreciate it. Another top 10 Patreon sign-upper is Ryan Giffen, who runs a finance and investing channel with a focus on crypto, and is another awesome person. And the last top 10 Patreoner is Pierre from PK Investing. Pierre's in college but makes videos when he can, usually about J&J, Tesla, QYLD, and some other things, and is a great guy. I strongly recommend that you join my free Dividend Discord, which has thousands of investors on it from around the world. Finally, unless you're part of SEAL Team 7, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.